Hey everybody, this is Hashir, your gold analyst at Gold Rush Reporter. Today, we're diving into a wild day for silver and gold, and I'll break down exactly what's happening in the markets, why it matters, and what you should be watching as an investor. Earlier in the trading session, silver made some dramatic moves. The price dipped below $49 per ounce, shocking a lot of people, but then bounced back impressively, showing just how volatile this market can be. By the end of the session, it was fighting to hold the $50 level, a key psychological threshold. This back and forth is typical for Fridays, but today's action had a few surprises worth analyzing. Before we get too deep into silver's swings, I want to share something interesting I noticed at my local bank, a coin that immediately caught my attention with its golden hue. It's rare to see something like this in circulation, and I'll explain why it matters for stackers like us a little later in the video. Turning to the broader metals market, rhodium saw a sharp decline, dropping more than 2.5%, while silver took a heavy hit early in the day. It fell to around $48.57 before recovering, showing just how quickly market sentiment can shift. Despite the early losses, silver managed to flirt with $50 by market close, highlighting resilience in this market even amid short-term turbulence. Gold, meanwhile, stayed above $4,000 per ounce throughout the session, offering some stability as investors navigate uncertainty. The economic backdrop adds context to these moves. Consumer sentiment in the US, as measured by the University of Michigan's November survey, came in slightly below October, but above expectations. While consumers are still struggling with high prices and shrinking wages, expectations for the future improved slightly. This kind of mixed economic signal often influences precious metals, with silver reacting more sharply than gold due to its smaller market and higher volatility. Inflation forecasts are also noteworthy. Short-term inflation predictions fell slightly to 4.5%, while long-term forecasts dropped to 3.4%. This hints at easing price pressures, which can impact Fed decisions and, by extension, the metals markets. At the end of the session, silver was fighting to hold $50, and gold maintained strength above $4,000. Technical indicators suggest we're seeing a tug-of-war between market fears and optimism, and investors should pay attention to how these levels behave over the coming days. Finally, for those looking to expand their precious metals holdings, our sponsor Summit Metals offers excellent service and competitive pricing. Check out their website in the description to see their products and how they can help you stack smartly. We're going deeper into silver's price action today and what it tells us about broader market trends. After dipping below $49 earlier in the session, silver staged a strong recovery, showing that buyers are still stepping in at key levels. Even with volatility running high, the market is signaling that $50 is no longer a ceiling. It could soon become the new floor. This is an important shift for traders and long-term investors because it shows growing confidence in silver despite short-term swings. One interesting factor behind today's moves is the release of US economic data. The University of Michigan's Consumer Sentiment Index came in at 51, slightly lower than October's 53.6, but above expectations. Analysts had predicted 50.5, so this was a mild surprise. While present personal finances and durable goods purchasing are under pressure, expectations for the future improved. What this tells us is that investors are weighing a mixed economic picture. Inflation is high, but it may be stabilizing, and growth signals are still present. Inflation trends are key here. Short-term forecasts dropped slightly to 4.5%, and long-term inflation expectations fell from 3.9% to 3.4%. These shifts suggest that price pressures may be easing gradually. For precious metals, easing inflation often translates into opportunities. Gold remains a reliable store of value above $4,000 per ounce, while silver's volatility creates chances for savvy stackers to capitalize on dips. Meanwhile, the manufacturing and services sectors are showing growth. The S&P Global Flash PMI Composite Index hit 54.8%, marking a 4-month high, mainly driven by the services sector. Manufacturing showed moderate expansion at 51.9%, down slightly from October's 52.5%. These figures are consistent with ongoing economic activity, but hint at potential challenges if industrial output slows further. As silver tests $50, it's important to note how markets are responding to Fed expectations. According to the Fed Watch tool, there's now a 69.5% probability of a rate cut in December. This is significant because lower rates generally favor precious metals, making gold and silver more attractive as safe haven assets. Finally, today's recovery is also a reminder that market swings often reflect sentiment more than fundamentals. Silver reacted more strongly than gold because of its smaller market size and higher leverage in trading. As we move forward, watching how silver holds key levels like $50 and how gold reacts around $4,000 will be crucial for understanding where the metals markets are headed. We're going to dig into the broader market forces affecting silver and gold, and why today's price movements are more than just random swings. Silver's rebound from below $49 to nearly $50 shows that buyers are stepping in at key levels. But the story isn't just technical, it's also fundamental. Inflation trends, tariffs, and consumer behavior are all playing a role. Even though the University of Michigan consumer sentiment reading came in slightly lower than last month, it still beat expectations, indicating that Americans are cautiously optimistic. People are feeling the pinch from high prices and shrinking wages, but they're not panicking. This balance between fear and confidence is creating volatility in precious metals. Tariffs and supply-side pressures are another factor. Higher costs for raw materials and imported goods can slow industrial growth, affecting silver demand from the manufacturing sector. Yet, despite these pressures, silver remains in strong hands. Investors recognize that the metal is a hedge against inflation and a safe haven during market uncertainty. Unlike gold, which benefits from institutional support, silver's smaller market means its price swings are sharper, making it a prime target for strategic stacking during dips. Let's talk about Fed expectations. The probability of a December rate cut has jumped to nearly 70%, according to the Fed Watch tool. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold and silver, boosting demand. Markets are increasingly pricing in the idea that the Fed may need to act to support the economy, particularly if consumer sentiment weakens or inflation trends shift. Another interesting aspect is market psychology. While gold has remained steady, above $4,000 per ounce, silver's recovery today highlights the market's sensitivity to both economic data and investor sentiment. Traders are reacting to every hint of inflation, rate adjustments, or economic growth. This creates sharp swings that can be profitable for those who understand the underlying fundamentals. Finally, today's price action reinforces the idea that precious metals are entering a period of consolidation before potentially moving higher. Silver is showing resilience near $50, while gold continues to hold a key psychological level. Watching how these metals respond to upcoming economic reports, tariffs updates, and Fed announcements will be critical for understanding the next phase of this market cycle. We're diving into the physical silver market and why the behavior of both retail and institutional buyers is critical for understanding price movements. While paper silver is heavily traded on exchanges, real demand is coming from physical metal. Bullion dealers and mints are reporting historically high purchases. Retail buyers, who often shy away during volatile periods, are increasingly stepping in to secure silver coins and bars. This is not just speculative buying, it's a tangible hedge against currency debasement and financial uncertainty. Even with silver hovering around $50, inventories are tight. Dealers are moving stock fast, and some are even flying in additional supply to meet demand. Institutional activity is another key factor. While they typically dominate gold, silver has seen growing interest from larger investors. Some funds and hedge positions are beginning to accumulate, recognizing the long-term value of silver as both a safe haven and an industrial commodity. Unlike gold, silver's market is smaller, which means even modest institutional inflows can move prices significantly. This creates an environment where volatility can be higher, but so are the opportunities for strategic stacking. We also need to consider how consumer sentiment and economic indicators influence physical demand. Data showing improvements in spending or sentiment, even marginally, can trigger short-term selling as investors lock in gains. Conversely, hints of inflation, weaker wages, or tariff impacts push people toward tangible assets. It's this interplay of economic signals and market psychology that makes silver so reactive on a day-to-day basis. Another important piece is how silver interacts with gold. Today, gold held steady above $4,000 per ounce, showing strength as a safe haven, while silver faced more dramatic swings. Historically, this ratio between gold and silver provides clues for future price movements. A rising silver price relative to gold often signals that market participants are gaining confidence in industrial recovery, while also seeking protection against inflation. Finally, the current market setup is telling us that silver is in a preparatory phase. The battle for key levels around $50 reflects both buyer confidence and short-term pressure from profit-taking or speculative trades. Watching these dynamics will be critical for anyone looking to stack or invest in silver. We shift our focus to the technical side of the market and what it tells us about silver's next moves. Understanding key support and resistance levels is crucial, especially during periods of high volatility. Silver recently tested the $50 per ounce level multiple times. This price point has acted as both a psychological and technical barrier. When silver dips below $50, it triggers short-term selling. But when it quickly recovers, it signals strong buyer interest. This tug-of-war creates opportunities for investors who are prepared to act strategically. Watching how silver reacts around $50 will give us clues about the strength of this ongoing rally. Another important factor is momentum indicators like the Relative Strength Index, RSI. Silver has experienced sharp swings, but the RSI shows that it's not yet overextended. This suggests that there is room for further upside before the market becomes overheated. Investors can use these signals to time entries, especially if they want to accumulate physical silver or silver mining stocks at attractive levels. Speaking of mining stocks, they often act as leverage plays on silver. Companies like Summit Metals, which we've discussed earlier, tend to exaggerate the moves of the underlying metal. A small rise in silver can translate into a much larger gain for these equities. Conversely, pullbacks can feel sharper. For long-term investors, this is an opportunity to accumulate quality miners during temporary weakness. Macro factors are also critical. Inflation expectations, rate cut probabilities, and consumer sentiment are all influencing how traders value precious metals. Today's data suggested a slight improvement in consumer sentiment and a modest dip in inflation projections, which helped gold hold above $4,000 and supported silver's recovery. Investors need to watch these economic indicators closely as they can impact both price direction and market confidence. Additionally, geopolitical events and policy decisions can affect metals markets. Tariff adjustments, global conflicts, or changes in central bank policy all play a role in shaping demand for safe haven assets. Being aware of these developments allows investors to anticipate potential volatility and position themselves accordingly. The takeaway from this technical and macro analysis is clear. Silver is in a consolidation phase with strong underlying support. Key levels like $50 serve as benchmarks for future moves, while momentum indicators and macro data suggest the rally has more room to grow. For those looking to stack, this environment offers strategic opportunities to accumulate silver and related equities, with an eye on both short-term swings and long-term gains. And thank you for staying tuned through this series. In this final part, let's tie everything together and focus on what it all means for silver, gold, and your portfolio. From the earlier parts, it's clear that silver is in a pivotal stage. After testing and reclaiming the $50 per ounce level, the metal is showing resilience. The technicals, including support around $50 and momentum indicators like the RSI, point to further upside potential. This isn't just a short-term bounce. It's part of a larger trend that's being influenced by both macroeconomic signals and investor psychology. Inflation expectations, the probability of rate cuts, and shifts in consumer sentiment are creating a backdrop that's favorable for precious metals. Gold continues to act as the ultimate safe haven, holding above $4,000 per ounce, while silver shows more volatility but stronger growth potential. These metals aren't moving in isolation. They're reflecting real concerns about currency stability, fiscal policy, and global financial trends. Investors should also consider the leveraged effect of silver mining stocks. Companies like Summit Metals provide an amplified response to silver price movements. While they carry higher risk during pullbacks, the potential reward during an upward move can be substantial. Combining physical silver stacking with selective exposure to miners allows you to balance safety with growth potential. The macro picture reinforces this strategy. Trade policies, tariffs, and central bank actions continue to influence metals markets. Geopolitical events, consumer behavior, and inflation expectations are constantly shifting. But the long-term trend favors precious metals as a hedge against uncertainty. Understanding these dynamics allows investors to act proactively rather than reactively. So what's the actionable takeaway? First, maintain awareness of key technical levels like $50 for silver and $4,000 for gold. Second, keep an eye on macro indicators, including rate expectations and consumer sentiment reports, as they will guide short-term price movements. Third, consider diversification with quality mining stocks for leveraged exposure to silver's upside. Finally, remember that patience and timing are critical. Stacking over time during dips creates a stronger position than chasing spikes. Before we wrap up, don't forget to subscribe to Gold Rush Reporter and hit the bell icon so you never miss updates on the metals market. Your engagement helps us continue producing insightful, actionable content for everyone looking to protect and grow their wealth in precious metals. Drop your thoughts and questions in the comments below. Let's discuss silver's next moves and what strategies you're using to stack wisely. Stay informed, stay strategic, and keep stacking smart. Thanks for watching, everyone. This is Gold Rush Reporter, your trusted guide in the world of gold and silver. Until next time, stay safe, stay vigilant, and keep stacking.